Now that we've covered how traders can participate in financial markets using CFDs, let's take a look now at what they can actually trade. Financial markets are made up of different asset classes, each with unique characteristics, risk factors, and trading opportunities. The most common asset classes are forex, commodities, stocks, indices, bonds, cryptocurrencies, and then derivatives. Now, traders can choose from a wide range of markets depending on their strategy, their risk appetite, and of course their areas of interest. Now, one of the most important considerations for picking any market to trade is liquidity. So what exactly is liquidity? Think of liquidity as an oil in a car's engine. Just like an engine needs enough oil to function properly, the market also needs liquidity. Without enough oil, an engine becomes sluggish, overheats, and can obviously seize up. Now, just as oil reduces friction in an engine, liquidity helps reduce friction in financial markets. It allows for efficient price discovery and smoother trade execution. So in that sense, liquidity refers to how easily and how quickly you can buy and sell an asset without significantly affecting the price. The more buyers and sellers that are actively trading an asset, the more liquidity it has. So why is liquidity important for us as traders? Why do traders usually trade symbols that have higher liquidity? Well, firstly, because higher liquidity usually means lower trading costs. When we pick assets with higher liquidity, it lowers our overall trading costs. That doesn't mean we shouldn't trade assets with lower liquidity, but in the long run, you want to make sure that you are trading things that have lower trading costs overall. Now, when it comes to trading costs, the most common one you'll have on your radar is what we call the spread. We'll cover what that means in the next video. Now, the second reason why liquidity matters is due to trade execution. You see, the higher the liquidity, the better the speed at which you can enter and exit your trades. With more liquidity, trades are more likely to be opened and closed closer to the intended price. That means better liquidity reduces your risk of being filled at unfavorable levels. Now, in markets with low liquidity, traders run the risk of what we call bigger slippage, leading to trades that are opened or closed at worse than expected levels. We'll look at an example of that in a moment. Now, the other big benefit of higher liquidity is overall price stability. Higher liquidity means prices move more gradually and predictably. In markets with less liquidity, we tend to see wild price swings. In other words, lower liquidity leads to more erratic price behavior and more unwanted volatility. Now, these two charts is a great way to visualize what we just explained. On the left, we have a chart of the euro-dollar currency pair, and on the right, we have a chart of the euro-NOK currency pair. Now, both these two charts are looking at the same day, the same moment in time. Both these currency pairs also includes the euro currency, but look at how different both of these charts look. The euro-dollar chart on the left saw gradual price moves throughout the session with smaller candles and far less volatility. The euro-NOK on the right looks like a total mess, huge spikes, no clear direction, and just a huge amount of unwanted volatility and price behavior. This chart is a really good example of why liquidity matters when choosing the symbols or the assets that you want to trade.